Investing in high growth startups can be a challenging and risky process, but with the right knowledge and strategies, you can increase your chances of success. In this episode, we will explore some of the best practices that you can use to identify and invest in high growth startups.
Sure, do you trust me?
Welcome to the Traveling Thief, where high flyers, new rich startup unicorns hang out. A high growth startup are companies that have the potential for rapid and significant growth, typically revenue or customer base. They often have a unique product or service offering, a disruptive technology, or a new approach to an existing problem. These companies may be in the early stages of development or may have already achieved some level of success. So let's get started with the first step. Conduct thorough research. To identify high growth startups, you need to start by conducting thorough research. This means looking at the industry or sector that you're interested in, market opportunities, and potential risks. You can use a variety of resources to gather information, including industry reports, online news sources, and professional networks. If you want to invest in a particular industry, you should learn as much as you can about that industry. Example, if you're interested in investing in the technology sector, then you should research current trends and growth opportunities in technology. Good way to do this is by attending conferences, reading trade publications, and following industry experts on social media. It's also important to understand the challenges and risks involved in the industry you want to invest. Every industry is unique before making any investment decisions. Step 2. Look for startups with a strong team. The second step in identifying high growth startups is to look for companies that has strong team culture and members. A strong and experienced team is crucial for the success of any startup. You should look for companies with founders and management teams who have a track record of success in the industry or a related field. The team should have the necessary skills and experience to execute the company's business plan effectively. They should also be passionate and committed to their business idea. You can access the team's strengths by looking at their past experience, educational background, and any awards or recognitions they have received. One of the best ways to assess the team's potential is to meet with them in person. You can learn a lot about their passion, drive, and vision for the company by meeting them face to face. 3. Evaluate the company's business model. The third step requires you to look for startups with a business model. This may include a unique product or service offering, a disruptive technology, or new approach to an existing problem. One way to evaluate a business model of the company is to analyze their revenue streams. The company should have a clear plan for revenue generation and a path for profitability. This should include understanding of their target market, pricing models, and marketing strategy. Another way to evaluate the business model is to assess the competitive landscape. You should look at the company's competitors, their strengths, weaknesses, and market share they hold. This will help you understand how the company's product or service stands out from the competition. Step 4. Assess the market opportunity. The fourth step in identifying high-growth startups is to assess the market opportunity. Look for companies operating in a growing market with significant potential for expansion. A large addressable market is a key factor in a company's potential for growth. You should also consider barriers to entry, including the level of competition, regulatory environment, and customer adoption. If the market is already saturated, it may be difficult for a new entrant to gain market share. Step 5. Look for traction. Startups that have already achieved some level of success are more likely to have the potential for high growth. Look for companies that have demonstrated customer adoption, revenue growth, or other signs of traction. You can evaluate traction by looking at the company's financial statements, customer reviews, and media coverage. You can also assess the company's user acquisition and retention rates. Step 6. Consider the funding stage. Startups go through different stages of funding, from seed stage to late stage funding. Each stage has their own characteristics and risks. Seed stage companies are typically early in their development and have higher risk profile. Series A and B companies and have a lower risk profile are typically more established and have lower profile risk, but may have lower potential for high growth. You should consider the funding stages in conjunction with other factors that we have discussed in the past 5 steps. And step 7, seek professional advice. This is the final step in identifying high growth startups that you want to invest in. Startups can be risky, and it's important to seek advice from experienced professionals. Angel investors can also consult with lawyers, accountants, and other professionals who specialize in startup investing. Professional advice can help you evaluate the risks and rewards of the investment and provide guidance in the best investment strategy for your portfolio. Identifying and investing in high-growth startups requires a thorough understanding of the market, the team, and the business model.